Mortgage charter, is it a good or bad thing? What is up with this mortgage charter? We're getting lots of questions. I'm getting sent lots of Instagram reels and YouTube video links to check out and sort of critique these particular items. And obviously I don't want to pass judgment on some individuals. Maybe they're just misinformed, or maybe they're really informed, but they're really trying to bait in a lot of people. On this week's episode, I want to go through our thoughts and opinions on the mortgage charter and what we see from our perspective about the banks and the government and how this will end up playing out, and share our opinions on it. So welcome back to the channel. It's Friday, Finance Fridays, and I'm your host, Anthony with InTouch Mortgage Solutions. And once again, if you're new to the channel, we invite you to subscribe so you can stay up to date with what is happening in the mortgage and real estate marketplace. And today we're gonna unpack a little bit more about this mortgage charter. And I'm gonna go off maybe on a little rant here because, a lot of us by now have heard about the mortgage charter. Maybe it's something that interests you. Maybe it's something that you would like to know a little bit more about, or maybe it's something you have no idea what this thing is supposed to do. And hopefully as a Canadian, you don't need any of these measures that are attached to this mortgage charter, because as of right now, the ink is still drying. We have a government that released it in the economic statement for fall, and yet there is no real truth behind what is to come. What we're expecting, or what the government is expecting, is that the banks will just abide by what they have put into place. And although I believe the banks will generally follow suit or adapt some of these very open-ended particular suggestions, we'll see exactly how this plays out. Remember, we saw back in 2020, when this whole pandemic had arrived, what the banks did with mortgage deferrals, and they sort of threw that onto the bank's plate and says, okay, you're gonna do this. And the bank said, okay, we're gonna figure this out, but they ended up doing it, they ended up putting all these measures into place, but not all the banks did this, right? If you had a private mortgage, maybe you weren't able to get a deferral. If you had a mortgage with one of the financially regulated institutions and broker-friendly banks, well, you were able to get 6 months. Maybe you're with one of these particular alternate lenders and they only did it for like a few months, or then you had to reapply. So there's a lot of things that the legal teams within these banks will need to review with their chairs and their shareholders, and obviously anybody who's making decisions at that bank, how these things are going to play out. Now, I had some quick sentiments before we get into some of these 6 items. The way I look at this particular mortgage charter is it can impact 2 different types of people. From the broker perspective, sitting here talking to individuals who one day hope to own a home, and although that sentiment is quickly dwindling with higher rates and obviously less homes being built, and yes, home prices could be dropping, and the TD Bank is telling us that 10% on average home prices are going to fall. We have to take everything with a grain of salt. Obviously, if you're one of these individuals who are sitting on the sidelines with money in hand or qualified to get out there, you're looking at it saying, hey, this is really good news because I can go out there and buy. You have these 2 different worlds being pulled at each other. And most of the clients that we talk to, they haven't seen, and even the Bank of Canada, Deputy Governor Carolyn Rogers really pointing out that they hadn't seen this mass home price collapse as they thought might have happened, because of artificially keeping Canadians in their homes. And whether it be the, obviously the deferral program, now obviously this mortgage charter, and extending amortizations and all these measures. Well, maybe for those home individuals, or home buying individuals, I should say, that want to get into the market, maybe they're not going to see that moment, because as more and more Canadians are offered opportunities and relief measures, well, they can basically kick that can down the road. And obviously this is the major question of what happens down the road. But, no one predicted what was going to happen during the, this pandemic. Nobody, if you would have sat there and said, look, home prices were going to, triple, quadruple, go up 50%, in the light of a pandemic, a global pandemic that kept people locked up at home, no one would have saw the writing on the wall. And then obviously inflation ticked up, and government spending, and obviously, yes, all this stuff, interest rates at all-time lows. And this sort of begs the question in my mind is, who is the government really protecting here? Are they protecting the home owners, or are they protecting home buyers that are looking to get into the market? What do you think? Let us know in the comment section as well. But either or, obviously many homeowners who currently are in financial situations who are looking at these measures and saying, hey, maybe if I do extend my amortization and refinance or do something. I can stay in my home. I don't care how much interest I pay, as long as I keep a roof over my family's head and don't put ourselves on the street. This is what we're hearing, right? There's two sides to every story, and I'm sure there's a lot of people out there that are saying, oh, we need to let capitalism run its course, so we need to let the banks fall and collapse, and then basically, you know, put all these people out of their homes so that all these people who have been waiting, that they come into the market, can go in there and buy and scoop up all these homes or bring investors back, whatever the conversation is. Obviously, that's not the way I see things playing out. Obviously, I could be wrong. But, you know, we look at the first point on this mortgage charter, and it is allowing temporary extensions on amortization period for mortgage holders at risk. This is something the banks have already been doing. They've already been extending amortizations, negative amortizations. Are they going to tell me now that the client goes into the bank and if they're at risk, and if you define who is at risk? So what is the bank saying? What does a person at risk mean? Does it mean that they're 2 months behind? Are they 3 months behind? Are they lost their job? What's the vulnerability here? What is the criteria to put at risk, right? So we have to first define at risk. But regardless, the banks are extending amortizations. They're doing it on these static mortgages with these trigger rates, where we've seen these mortgages hit, you know, 50, 60, 70, 80, 90 plus years. I don't know if they're going to allow individuals to extend their mortgage beyond 30 years. I think what we might see here is individuals that have a mortgage, they've paid it down maybe to 10 or 15 years, or maybe less, or even a little bit, you know, maybe they had it for 5 years. Maybe they'll allow them to re-extend up to 30 years, because OSFI is really breathing down, the Office of the Superintendent of Financial Institutions is really breathing down the bank's necks to make sure that, obviously, with their provisions for credit losses and bank earnings this week, not really that good, you know, as they have to put more money aside for these potential losses. You know, is that something that the banks are willing to do? Are they willing to potentially do that? On the other side of that is the bank's ability to profit, right? Generally, when interest rates go up, banks profit. Banks tend to be a very sound investment, but obviously it's proving to be the opposite right now. But obviously, what happens when those provisions for credit losses don't pan out? Let's say they don't need all that money. Are they going to be buying back some of their stock? What will happen, right? That is a big question. But realistically, the banks are standing to make a lot of interest for a longer period of time, especially if Canadians cannot leave that particular bank. Maybe it's because they're stuck there. Maybe they don't qualify now because they don't have one particular item that fits on this list, but they're stuck with that bank. Maybe, you know, they qualified under a certain time. Maybe they qualified a long time ago before the stress test, and now they're only coming through and they, you know, maybe need some assistance, but maybe their income is still solid. Maybe their income is still sufficient, but they don't qualify to meet this at-risk or vulnerable situation. Now, the other thing is waiving fees and costs that would have otherwise been charged on relief measures. Now, this is something that I believe is definitely really good. I think I touched upon it last week. For a bank to charge money on top of relief measures is absolutely heinous. I think, but obviously, you know, the banks are notorious for charging fees. They are fee-based. When interest rates were pretty much at zero, banks were making money on fees. So they have to charge fees in order to recoup some of those profits and profits they've made. But at the end of the day, I think this is something that the government maybe should really look at. But how do you implement this, and how do you design something that's going to work around this? Even Chrystia Freeland coming out saying, you know, they want the banks to adopt this particular beautiful mortgage charter, but I don't really know if they've actually talked to the heads of the bank or said, how are we going to do this? They just said, let's put this in our economic statement and hope, I think, and I would love to be wrong, but, you know, let's hope that this looks really good for our party and for the government, and you know, basically maybe the banks will listen to us in some shape, way, or form when it comes to all the things that they're talking about. Now, number 3, this is the big one that I've been seeing all these videos about, was not requiring insured mortgages holders to requalify under the insured minimum qualifying rate when switching lenders at mortgage renewal. So obviously you have to look at how these particular situations will play out. This was something that was already in a lot of the legislation. You know, as these things evolve, OSFI comes out and says, look, these are the changes that we're going to be making. And although we knew that this was in place, and some of our lenders were not really requiring insured mortgages to be requalified under the mortgage qualifying rate. Some banks were, and this was the designation where it was the verbiage is in the documentation, but it is up to the lender to make that decision on how they want to push forward. It is no different than, for example, individuals who have a line of credit, home equity line of credit, depending on their bank, and specific banks use that as a negative liability. So even if you had a zero balance on a line of credit and you're going to qualify with a lender, let's say that line of credit is $300,000. If you have a zero balance, they'll use that line of credit particularly as a liability. They'll make up a payment over a 25-year term at the qualifying rate, yada, 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 and they'll add it into your liabilities, either having to close that line of credit or you're making enough money to qualify with it. But there's some banks that don't do it because it is in the writing. It's up to the bank. It's open for interpretation for how the bank wants to adapt it. And I think this is a good one. I mean, obviously, if you are insured in an insured mortgage and you're looking to renew your mortgage, obviously this is really good. Because it does give you the ability to compete and switch banks, especially if you don't like what the lender is currently offering you. But I think for a lot of individuals, depending on where they are in their financial journey with their mortgages, and to be honest, I really think that they should allow this particular mortgage qualifying rate to be omitted. If you're in a mortgage and you're looking to switch lenders when your mortgage comes up for maturity, right, when it expires, you should be able to switch to a different lender because it gives you more competition. It gives you more ability to choose where you are. And especially if you're not asking for new money, that's the key caveat right there. You are not asking for new money. You're not refinancing. You're just switching over. You're looking for a better rate at the time of renewal. And most of the times, a lot of lenders, may offer you the good rate at renewal, but sometimes there's way better products out there. And if you're having to undergo that qualification rate, the contract plus 2%, you might be not enticed to go through that process. So I think they should really open that up. Let us know what you think about that. Should all mortgages be open to being able to be switched or transferred, especially if they're not having the fact that they don't need any new money, they just need to switch. Number 4 is contacting homeowners 4 to 6 months in advance of their mortgage renewal to inform them of their mortgage renewal options. And I think this is a big one, should go without saying. As brokers, we reach out as early as we can to our clients to notify them of their mortgages coming up so that they have the best options. But a lot of lenders may choose to wait until the last minute to give that client not enough runway to go out there and find an opportunity. But I think with what's happening right now, the banks should be forced to reach out as soon as possible, which, I mean, if some of the banks reaching out to you, you should be reaching out to a mortgage professional to have a second opinion on that, because as rates adjust, you don't want to get out of your mortgage too soon, especially if you're in a really low rate and your mortgage is up in 5 months or 4 months. You might be giving up 3 months of interest at the lower rate before you jump into that higher rate. So riding that mortgage out is very, very important, but understanding your options is key. And I think this is a good one. And then number 5, giving homeowners at risk the ability to make lump sum payments to avoid negative amortizations or sell their principal residence without a prepayment penalty. And that is something that is really, really good, I think. But here's the way I look at it from someone who's worked in the banking system. Is the bank going to give up their penalties? Is the bank going to give up something that has been so lucrative for so long? And by that, I mean most clients, most banks would sell a 5-year product when 5-year products were really popular. And this was something we would always talk about. 65% or 67% at the time would not get to the 5-year mark. They'd either be refinanced or restructure or moving. Maybe they didn't want to port their mortgage. Maybe the interest rates had gone down and they don't want anything to do with that particular lender or product. So they would pay a penalty and the banks would make their money. I think that obviously for individuals at risk, this is really good because there's nothing like adding insult to injury if that individual is trying to sell their home, being proactive before it goes into power of sale or foreclosure, where the bank basically notices, hey, that home is now 90 days in arrear and we need to enact a power of sale. Now, obviously, power of sale means they put the home up, they recoup their losses from their mortgage. It's not like the US, and obviously it depends on the province, not like foreclosure where the bank repos the house and sells it and profits everything. In a power of sale, the homeowner, if there is anything left over, does get that back. But obviously by the time they add on those fees and the cost, banks don't necessarily really want to be putting people in a power of sale situation. It is costly, it's expensive, it draws out. They have to get realtors and lawyers. It's so expensive. So, they potentially may look at this option, maybe foregoing the penalty, or even extending that amortization if it means keeping them in the house, if you think about it. Because if the banks are going to opt to basically continue making money or go through a really expensive process, they're probably going to choose the longer amortization. And then obviously, if you're paying down your mortgage, let's say you're in a static mortgage with one of those trigger rates and you're saying, I want to bring my mortgage back into line. I want to bring my amortization back to where it should be. And I have some extra money, I want to throw it at it. If you're throwing more than the amount that's on your contract, then you're going to get charged that penalty. And you shouldn't be charged that penalty, especially if the bank is saying to you, look, you're on this trigger rate. We want you to bring your mortgage back into line, or I want to bring my mortgage back into alignment. Why are you going to charge me if I'm putting down more than the 15 or 10% that is prescribed on that contract? So I really think that this is a good one. And then finally, is not charging interest on interest in the event that mortgage relief measures result in a temporary period of negative amortization. Yes, absolutely. I don't think we should be charging interest on interest, especially if it's something that, maybe the government or the negative amortization is an OSFI, the failure for the bank to step in and remedy these situations. Obviously, these are things that should be brought to the forefront. So charging interest on measures that are out of the client's control, it goes without saying. But at the end of the day, as I said, it depends on the lender's interpretation of how they're going to accept what the government has put forward. They don't necessarily have to. It is voluntary. They probably want to show favor with the government, but realistically, they have no inclination to do that. And this is where all of these rules come into play. As much as they look really good on the surface, and for a lot of individuals who may be wanting to get into the housing market, hey, look at all these measures, this mortgage charter that's protecting me in the event I get into the market and bad times come ahead. Hey, look at this charter. Or I bought a home, look at what the government is doing to protect home ownership, and it is impacting both sides of the equation. So I want to hear from you, our viewers. What do you think about the mortgage charter, the reality of the mortgage charter? Let us know in the comment section as well. Don't forget, if you are new to the channel or you're an existing returning viewer and you haven't subscribed, please do so. Helps the YouTube algorithm, helps get this content out to as many Canadians as possible. We'll leave the video here. Wishing everyone a wonderful Friday and an even better weekend ahead. We'll see you next week.